Good morning, everyone. My name is Frank Milone. I'm one of the partners here at FML. We're currently going to give probably another couple of minutes as people are entering into the meeting, and then we'll get going. So give me a couple of minutes. And again, if you have any questions during the event, there's a live Q&A process on the right-hand side. I just had one come through by Eric. Thank you very much, Eric. And we will try our best to answer the questions during the event. And we will also either do that in writing and post it on the live Q&A, or we will try to verbalize our responses if we think it's something we can answer immediately. And as I've mentioned in the announcements, if you're having trouble seeing the slides, please click the live button on the bottom left. And if you have any other issues, we'll do our best, but to answer them. So again, we're going to get going in a couple of minutes. We're giving people an opportunity to jump in as the numbers are continuing to rise here. We're expecting close to 100 people. So I'm going to give it a couple more minutes. Respectful, obviously trying to respect people's time. It's a busy day. We will continue to answer questions after the 12 o'clock end. If people want to stay on, we'll do our best if there's questions that are outstanding to continue to answer questions. For those of you who are joining in, we're going to give it a couple more minutes, and we'll get going in about a minute or two as people are still joining the presentation. All right, fantastic. Well, I'm going to start the presentation now. Thanks everyone for joining us this morning. My name is Frank Milone. I'm one of the founding partners of FML. And on the call today with me is Bill Claffey. Bill is a partner in our tax department, and we'll be presenting most of the detail today, and I'll be jumping in as well. We also have a couple of other FML folks on the presentation with us. We have Amber Tucker, who is a director in our assurance department, and she has a focus on working with not-for-profits. She's going to be helping today with a focus on answering any questions that the not-for-profit sector may have in regards to the PPP and the CARES Act. And you can reach out to her directly after the event if you have any other questions. And then we also have Deb Puro. Deb is the senior manager who helps run our accounting services practice. Deb's on the presentation today, and we'll be answering questions in regards to some of the detail calculations that she's helped our clients with as far as getting prepared for both the PPP and the EIDL loan process, and working on helping getting that information ready for our clients, and she'll also be able to answer any questions that you pose today. So FML, we are a full service accounting firm with 13 partners and over 80 people in total. We have our headquarters in Glastonbury, Connecticut. We also have a fully staffed office in Enfield, Connecticut, and we have satellite offices throughout the state in New Haven, Stamford, and other locations as well. We have a COVID task force that we put together. Bill is on it, Amber's on it, Deb's on it, myself and others, with the sole purpose of staying on top of the response to CARES Act, the legislative response to the pandemic, and trying to do our best to get the information out to our clients and to our contacts. We have a dedicated web page on our website that's sharing this information, and we really recommend that you stay on top of it by going back to our website and looking for updates. So without any further delay, I'm going to start, and I'll move it over to the next slide, and I'll ask Bill to jump in, and we'll start the presentation.
Great. Appreciate it, Frank. Just a quick overview. So as Frank mentioned, I'm a partner at FML on the tax side. My focus is on state and local taxes and incentives. I'm an attorney by trade, so I also get involved in a lot of tax policy and tax controversy matters. So this kind of fell right in my wheelhouse. And so as a member of the task force, Frank and I have been pushing out updates to our website. You can go on the website. We have about 10 or 12 pieces that are up there, and hopefully those address your questions. For those of you that had attended one of our prior webinars, welcome back. Appreciate you guys coming back. Since our webinar on Monday, there's been some significant updates. If you received our slides, those slides had the updates as of that material came out Monday night. So we're just going to jump in. A lot of this is going to be duplicative for some of you, but hopefully you still find it useful. And for those that are new to the webinar, we'll go through this and answer any questions we can. So first, let's get a big picture. Once this COVID-19 coronavirus hit the country, the legislature, the federal government responded in a number of different acts, and there's some more to come. But the first was on March 6th, the Coronavirus Preparedness and Response Supplemental and Appropriations Act that expanded the Economic Injury Disaster Loan Program, the EIDL program, which we're going to talk about in some more detail. Then fast forward to March 14th, and you've got the HR 6201, the Family First Coronavirus Response Act. And keep in mind that these acts are lengthy, but we're pointing out kind of the key provisions here. But that mandated sick leave and family medical leave for certain folks that were impacted by COVID-19, and we're going to get into some detail there. And then we go to March 27th, almost 2 weeks ago, the Coronavirus Aid, Relief, and Economic Security Act, otherwise known as the CARES Act. That had a number of provisions, the Paycheck Protection Program being the one that most folks are in tune to, but also had the stimulus, which was on the news early on. We're going to get into some detail on there. The Small Business Debt Relief Program, if there's questions on it, I can answer those. We're not going to get into too much detail on that today. The Emergency Economic Injury Grant, which is part of the EIDL program, we'll talk about. And then there's a number of tax provisions. So we're going to hit those at the end of the webinar today. Okay, so let's jump right into the EIDL program, this disaster loan program. It's the SBA has been giving out loans to small businesses for decades. I believe this program goes back to the 1950s, and typically it was covering disasters that were more kind of FEMA type related, tornadoes, hurricanes, so forth. What they did when the new legislation expanded this EIDL program, the disaster loan program, to many state and local jurisdictions that were impacted by COVID-19, and they trickled in over time. And now I believe all 50 states and all local jurisdictions are considered disaster areas by COVID-19. And what it is it's a small business loan up to $2 million. It's got a 30-year maturity rate, and the rates there for profit and nonprofit businesses are there, 3.75 and 2.75 for your nonprofits. The new legislation allowed for a 1-year deferral of payments, and noting that interest is going to continue to accrue on those loans. There are eligibility requirements. So as with most SBA loan products, you have to be qualified as a small business, and that there are some variations on that, but your typical definition is having 500 employees or less. There were a number of questions related to affiliation rules, which we'll get into in a little more detail with Frank's presentation, but that's kind of the basic framework of the disaster loan program. Eligible uses. The disaster loan program is got a much broader eligible uses for the borrowers, and we'll get into what the really defined uses are for the PPP loan. But the disaster loan is any kind of working capital. So I've listed out the different types of eligible uses that you can use the loan proceeds for. A lot of folks have been asking a question: hey, can I do the disaster loan and do the PPP loan? We'll get into that timing, but the answer generally is yes. The emergency economic injury grant was also in addition to the disaster loan program, and that allows borrowers to get a $10,000 grant if they're applying for a disaster loan. That grant is a couple key factors of that. One is it's the intent. Now, I've heard some stories from some businesses that say that while it's great, they haven't received their money yet, but it's a $10,000 grant upon the application of the EIDL loan. The intent was to get those funds in the borrower's hands within 3 business days. And folks that were applying for an EIDL loan were not required to actually be approved in order to receive this emergency economic injury grant. So we've been advising a lot of clients, if you don't fit the right profile for the PPP loan, but need some cash, look at the disaster loan program for sure. Even if you can't meet, and we're going to get into the next slide, we're going to get into some of the requirements, but even if you can't meet that or even denied your EIDL loan application, which is going to be going directly through the SBA, you're still supposed to be approved for this emergency economic grant. It's $10,000 and certainly can help the right business get through this time. Go to the next slide there, Frank. Okay, great. So EIDL loan, we just listed out some miscellaneous provisions there. So the personal guarantee, that's typically a requirement in an SBA product. They push that amount to only loans over $200,000. The collateral, again, your typical SBA loan would have that. Now they're only requiring collateral if your loan is over $25,000. And I've spoken with a lot of small businesses, anywhere from startup to companies that are fringing on that 500 employee baseline. And those small startups, they can apply for a loan of $20,000 that will really help them with their operations in the next couple months, get the $10,000 grant, and can certainly be some very useful funds for the business. The financial analysis, ability to repay, that's going to be done, right? They're going to want to make sure that you can repay this type of loan. We'll get into the PPP loan, but which is not a requirement. For this one, it is. Credit check, they'll perform. Importantly, they waive the credit available elsewhere. Typically in your SBA loan product, they want to make sure you've exhausted all your other options to get credit. They waive that for purposes of this loan. There's no requirement to provide prior year tax returns, and that goes in line with the next bullet, which is you only have to be in operation as of January 31st, 2020. So can certainly be eligible for new businesses. I've gotten some questions on the ability to repay, startup type businesses that don't have any revenue. Can they potentially pass that test being pre-revenue? I wish I had a great answer for you. I haven't heard from the SBA on how they're going to analyze those companies, if they're going to do some sort of a forecasting based on their business plan. But my recommendation would be get into the queue if this program works for you, and kind of work out those details with the SBA in terms of kind of going through that analysis. Interaction with the Paycheck Protection Program loan. This is going to be an important caveat to everything we discussed today. As we mentioned, there's been 3 phases of legislation. I was reading this morning that they're going to try and infuse another $250 billion into the PPP loan program. They're also starting to discuss a CARES 2 provision. All of these acts have, it's kind of a spider web, and you got to understand how the certain programs work with each other. But to answer this question about the interaction with the PPP loan program, you can apply for both, but they specifically provide that you cannot use the funds for the same sources. The terminology they use is duplicative uses. If you, and the other part is if you do apply for your EIDL loan and do get that emergency economic injury grant of $10,000, just know that if you then apply for a PPP loan and get that part of that loan forgiven, that $10,000 comes off the top. So if you had a loan of $100,000, you go through the calculation, you've got $100,000 of loan forgiveness pursuant to the PPP program, but also received the economic injury grant, your loan forgiveness would be reduced to $90,000.
Hey, Bill.
Yeah.
Have a couple questions regarding the personal credit score relating to the EIDL loan. Do you or anyone else on the call know if that's a personal credit score or is it a business credit score that gets applied into that EIDL loan?
I believe they're looking at both, especially if there is if the loan is going to get over the personal guarantee amount. But I don't have that firsthand information, Frank. But that's what I think is going on based on some other conversations I've had with some other folks.
Okay. And we'll get more information on that and respond to that one in writing after the event then.
Yep.
All right, great. So I'm going to take over on the SBA affiliation rules. So as many of you know, the CARES Act expanded the financial assistance available with the Paycheck Protection Program that we'll talk about next, and also the EIDL loans. All of these come under small business current processes, 7A loans, 7B2 loans, and as much has been discussed as regarding to qualifying for these loans, you have to be a small business as defined by the SBA. Normally that relates to your employee count, 500 or fewer. And then it also sometimes designates its way back into certain size standards in relation to the NAICS codes that you're assigned. And there's a test of, whether you're meeting those 500 employee tests or the specific test under the standard, whichever one is greater. And there's been a lot of discussions as there's also income tests and there's also some other tests that relate to the SBA qualification. There's a lot of things that the applicants need to do to make sure that they're applying, when they're applying for this assistance, that they qualify under the SBA rules. One of those complications relates to the affiliation rules that are sitting within the SBA guidance. And this has become quite a bit of an issue in certain segments of our client base, including those that are either what we would call venture capital backed companies or private equity backed companies, or even companies that have a cap table that has minority investors that are either private or other companies. And it's also come up in the not-for-profit sector as relating to whether you have affiliate relationships between board members who are running different companies. So this has become a topic of conversation, and it's a very big deal, because if you're deemed an affiliate, you have to take into account that affiliate's employee count as well. So if I'm an affiliate with a company, a different company, and that company has 450 employees and my company has 75 employees, we have to be deemed one company under the application, and we're now over the 500 employee limit, and therefore we are not considered a small business and we cannot apply for the loans. So the SBA has been trying to come out, and the guidance has been coming out pretty fast and furious on the affiliation rules. And there are two main tests. It's really what is defined as a control, who controls another company, or do you have the ability to control another company, or does a third party have the ability to control? And it's usually based upon two major factors, equity ownership and control rights. So on April 3rd, the Small Business Administration, the U.S. Treasury issued additional guidance, because this was becoming a very, very hot topic, because it's ultimately the responsibility of the borrower. So the person that's applying for the PPP or the EIDL loan process needs to determine, as part of their application, whether they qualify under the small business affiliation rules. And so the guidance that came out on April 3rd really defined four major tests. There's an ownership test. There's a test relating to how you treat certain equity rights under debt and other equity related instruments you may have outstanding. There's an affiliation that's now being based upon management and the management within the company that you're operating, and then there's an affiliation based upon the identity of the interest. So we'll walk through those rather quickly, and I recommend that you continue to stay up to date on this with our website, because we're constantly trying to update the guidance that's coming out fast and furious on this. So the test one, based on affiliation, based on ownership, in essence, it ultimately means if you have another entity who has 50% or more of the voting equity, you ultimately are affiliated, and you have to combine those companies when determining your qualification under the SBA rules. There's also some clarifying rules that came out in regards to minority holders. And the biggest question here that comes down to minority holders. So if you have someone who owns under 50%, you still have to go through what they call the control rights concepts of that minority holder in your operating docs and your governance docs, and determine if that minority holder has any control rights in relation to preventing a quorum or blocking action of the board or the shareholders. If they have these provisions within their governance right, the SBA will probably deem them affiliates, even if they're minority holders. The National Venture Capital Association has come out with a lot of guidance relating minority shareholders and how to evaluate control right provisions. And I would strongly recommend getting a lawyer involved if you have minority holders that have certain rights and privileges within your operating and governance docs to determine if you needed to basically count those minority holders as affiliates within your qualification process. The second test talks about rights arising under stock options, convertible securities, and other agreements to merge, and basically talks about the fact that when determining the size and the power to control an applicant, if you have rights under options, convertible securities, and other agreements, those rights will be treated as if they are exercised, not if they're not exercised. That still means you need to count them in your ownership calculations as if they had already exercised those rights. There's also been a lot of clarification within the guidance on things that do not need to be included. I'm not going to read them all in the nature of the time here, but ultimately, if those securities have the ability to control or upon exercising control the company, ultimately you have to assume that they have already exercised those rights. Affiliation based on management, this comes into play a lot in a not-for-profit, I believe. If you have a management team of a company that also controls the management of another company, that's an affiliation concept under the SBA. You have to combine those entities when doing your testing to determine whether you qualify. You also have affiliations where if I have an individual or a company that controls the board or the management of a company, and then I also control another board or another management of another company, either directly or through a management agreement, I also have to deal with the affiliation rules as outlined by the SBA. And then lastly, there's an affiliation based on the identity of interest. This comes to play a lot when you have close family relationships as defined within the CFR that's outlined in the slide deck. If you have similar business interest or economic interest, you basically have to determine if that family relationship is going to deem itself an affiliation, and again, determine if those need to be affiliated as you go through the SBA process. There are certain rules that are waived for certain NAICS codes. There's also a waiver if you're being funded by a SBIA related company. Most of this is relatively complex, and we strongly recommend if you have a complex cap table, or if you have minority holders, or if you have board relationships that need to be understood, that you get legal teams involved to evaluate this prior to submitting your applications. One thing I will say is there's also been a lot of questions in regards to 20% owners being identified on the application for the PPP. If there's a 20% or more owner, you have to list them out on the PPP application. And then there's our certain rules about explaining relationships, ownership relationships, and management relationships. And we see a lot of companies adding an addendum onto their PPP application to make sure that the SB or the bank that is working through the PPP process can understand all of those affiliate ownership and why they are not, or why they are deemed affiliates. So with that, I'm going to turn that over back to Bill, and he will start getting into some of the detail on the PPP.
Great, thanks, Frank. One of the things that, just in reference to your comment there, Frank, I've heard from a lot of folks over the last couple of days as everybody's getting their applications in, and every bank is doing it a different way. And anyone that I've spoke to that's on this call will know that I've called it the Wild West. And whereas some banks are allowing or putting up setting up a portal and allowing you to send a PDF of the documentation and your application that you've downloaded from the SBA website. Other banks are having you go through kind of an e-file process. And that question that you just brought up, Frank, that 20% owner, the banks are asking them to not only list them out, but provide personal financial information, including assets and liabilities for the owners. And that can be, some folks either don't want to provide that. The PPP program specifically provides that the personal guarantees are waived, and we'll get into that. But it's been interesting to hear all the different experiences that our clients and other folks that we've talked to have had during this process. I don't know if you've heard anything different, Frank, from your end, just with different experiences folks are having with the banks, and whether there's any ways to kind of circumvent some of these requirements that they're getting from their individual bank.
Yeah, I definitely have heard in a variety of my conversations with my clients who tend to have sophisticated cap tables, that their banks are treating it differently. Some of the portals are asking for that information. There are a lot of, I think there's a lot of confusion because I think the banks are using an old SBA platform for the PPP loan process. And under an old SBA platform, as you may imagine, there is a personal guarantee concept that goes along with it. Most are calling their banks, and most are dealing with it by trying to enter in information at a level that doesn't require the personal financial information to be entered. Most often what we're being told is banks want to understand what owners are 20% or more. They don't usually need the personal financial information. They want it more for understanding the affiliate rules and the ownership rules, and not to get to the personal financial information.
Great. Okay. All right. Let's jump into the Paycheck Protection Program, as I'm sure that's what a lot of folks are most interested in. So as I stated before, the program was added March 27th. The applications went live on April 3rd for some banks, while other banks had delays in setting up their portals. And the intent was to allow businesses to apply on April 3rd and allow sole proprietors and independent contractors, which we'll get into that issue, which has been all over the place in the last week, to apply on April 10th. But as most of you know, it's a loan program. It's got forgiveness provisions. The loan is up to $10 million, but they're going to take a calculation of your average monthly payroll costs and multiply that by 2.5, and that will be your loan amount, unless you reach the $10 million threshold, at which point you would be capped by the PPP loan amount. One other consideration is I have heard from some folks that they had applied for an EIDL loan. And can they also apply for a PPP loan? You can actually use the PPP loan you can actually refinance your EIDL loan into your PPP loan. But that EIDL loan had to have been applied for by April 3rd. Okay, so when we get into this average monthly payroll cost, a lot of questions on, well, how do I calculate that? It's under statute, it's a 12-month period, but the guidance that came out on Monday night, and I think that this was in response to the way the banks were typically handling their applications. They were asking folks to submit 2019 data. And so the new guidance that came out Monday night basically said you can use either. So obviously, if you're looking at your application, haven't filed it yet, look at what gives you the best result and use that as your calculation, because that's permitted under the new regulation. If you were not in business, so your startup, you were not in business, and we're interpreting it as being in business for every day between the period of February 15th, 2019 to June 30th, 2019, then instead of using your prior 12 months or your 2019 data, you can use basically January and February of this year, 2020, to calculate your average monthly payroll. Payroll costs. So we've got all the bullets here. I want to kind of hit the highlights from the new guidance. So you're looking at your salary, wage, and commission and other similar compensation. Other similar compensation, this has been a kind of a point of some pretty heavy debate, is whether that would include guaranteed partners. Our understanding, and I think the understanding from most of the folks and most of the guidance that I've seen, although the official SBA guidance, I don't believe that they've addressed this directly, but everybody's reading that to say other similar compensation could include guaranteed payments made to partners. That compensation concept is where the cap of the $100,000 comes in. That also was a source of much debate whether the entire payroll was capped at 100,000 or whether it was just the compensation piece. The new guidance answered that question and stated that it would just be the compensation component of your payroll costs. Then you're gonna next bullet, you're gonna add your family vacation, family medical, sick leave. Just note that if you, and we're gonna get into the HR 6201, but if you were mandated to provide sick and family medical leave based on COVID-19, then that does not go into that calculation. Your group health care benefits, including insurance premiums, some folks asked that, including disability, some folks asked about that, paid by the employer. Retirement benefits paid by the employer, and then state and local taxes on the compensation of employees. I got a couple questions last week about other state and local taxes. Could you include kind of non-compensation related state and local taxes, property tax, other, and that's not includable, right? So you're just looking at the state and local taxes on your comp, including unemployment taxes. Okay, so let me get into the do not include, and this was the guidance kind of clarified a lot of these items. You are not going to include the employer funded component of your employment taxes. So think FICA. That was the CARES Act, and the guidance that was coming out was kind of all over the place. At one point they were saying exclude February 15th through June 30th of 2020. That made absolutely no sense. So they've just excluded that component. However, the employee piece on the withheld taxes is going to be includable. So when we look at your salary and wages, you're starting with gross wages. Do know that this has always been the case. If you have employees that reside outside the U.S., they're not includable in your calculation. And then the next bullet, the independent contractors, again, a huge source of controversy. And I don't know that the guidance applied the law as it's written by the CARES Act, but we're working in a very fluid world here, and we're working off the most recent guidance, which was issued Monday night. It was updated, I believe it was updated last night, but there's only a couple updates. So any payments, if you're an employer making a payment to an independent contractor, that is currently excluded for purposes of your calculation. Now, I had a client that I was speaking to Monday morning. They only have independent contractors. They don't have any employees. And he was asking, what do I do here? And in that situation, we discussed it. I gave him the pros and the cons, but his situation was either apply for the loan and get something, or don't apply because he did not have any payroll costs. Thankfully he applied for the PPP loan on Monday afternoon, included his payments to independent contractors, which at the time I would say was very up in the air. That loan has been approved, at least by his bank, and we'll talk about kind of the approval, what we're seeing in terms of the approval process. And because the new guidance that came out on Monday night basically said independent contractors were excluded. However, if you were relying on guidance prior to that announcement, you could operate under the prior rules. So again, if you're filing your application between Monday and going forward, independent payments to independent contractors will not be part of your payroll costs. Okay, so that's the last bullet there that I mentioned. Terms, it's 2 years. Like I said, the CARES Act provides for up to 10 years, but they're saying 2 years right now at an interest rate of 1%. And those loans are forgivable, which I think everybody knows, and we'll get into that calculation. The deferral period is an automatic 6-month deferral. If you need an additional 6 months, you can request that, just noting that interest accrues during that period. Eligibility. So this, I didn't mention it in the discussion about the EIDL loan, but one point I did not mention is the number of companies that are eligible for the EIDL loan. They really expanded it to almost every nonprofit is included in there. If you're looking at the PPP program, it's more restricted, at least by the CARES Act. So you're looking at your small business factor, the 500 employees, or the SBI size standard index. You've got your 501c3 nonprofits, the veteran organizations, tribal organizations. They're treating sole proprietorships and independent contractors as separate eligible parties. So if you are an independent contractor or a sole proprietor, you are going to be submitting your own application. We can debate about the theory as to whether that makes sense or not, but I can give you a pretty easy example of why it doesn't. You could have, I mean, think of a company like Uber. They're going to have, hundreds of thousands of independent contractors that might all be applying on their own. Self-employed individuals, noting that under the PPP program, when they look at that 500 employee test, they're looking at it on a per location basis versus aggregating all the locations. And then the affiliation rules that Frank discussed, they're waived for franchise type businesses. One other eligibility rule that's not as well advertised, but we've looked at it in the last couple days, is there's this alternative size standard that's been enacted pursuant to the CARES Act. And basically it says that if you have net income, average net income in the full 2 fiscal years prior to your application of $5 million or less after federal income taxes, and you have a maximum tangible net worth of less than $15 million, you could also potentially fit into the category of an eligible recipient of the PPP loan. I haven't gotten a lot of questions on that, and I haven't really seen that. I haven't worked with an applicant that had to apply that standard. We discussed it with a couple folks, but I don't know the results of that application as submitted. Eligible uses, so fairly defined here for the PPP program. So you're looking at payroll costs, the health benefits, interest on mortgage obligations, rent and utilities, and then interest. They state that any interest on any debt obligation that you entered into prior to February 15th is an eligible use of the funds. Now we got to make sure we understand eligible uses and also eligible uses available for loan forgiveness. So let's go to the next slide there. Okay, loan forgiveness. So obviously big piece of the program here. What's everyone interested in? Obviously everyone's looking to make sure that they can get their loan, and will it be forgiven and in order to maintain their payroll. So what after you receive approval, you will have, and my sense is there's 2 pieces of approval here. You're going to get an approval from your bank, and the bank's due diligence seems pretty light. They have to verify payroll documentation and some other items, but I don't believe, based on the stories I've heard of how quickly they're approving the loans, that they're going into a lot of detail on your average monthly payroll calculations. But we already have clients that are receiving approval letters. My understanding, though, is that approval is going to go to the SBA. The SBA is then going to do some additional diligence, and then at that point they'll do another approval, and then the funds will be dispersed. But looking at what's included in loan forgiveness, you have an 8-week period to spend those PPP funds on your payroll costs, your interest on mortgage obligations, your rent and utilities. And the most recent guidance, and Frank, maybe you want to comment on this, but I believe that they said it's from the date of dispersal, right? In terms of the loan. That's right. Yep.
Yeah. So I think the first disbursement happens from the bank to the company is the start of the 8-week period.
Great. Yeah. So you could have, it sounds like there could be multiple approval dates here, but they're looking at the 8-week period as following the disbursement date. We've gotten some questions on whether you can you get approved and have a dispersal date that's not immediate. I don't know the answer to that question. Obviously, we're going to track that and see what we can find on that. But the way the guidance is written now, it's just date of dispersal, and it doesn't mention whether you can defer your dispersal date. So you've got that 8-week period, and then you've got reductions, right? So if you have a reduction in FTEs, and that's full-time equivalents, again, another area that there's a little bit of controversy on, is it really a full-time equivalent employee, which is the way that the act is drafted, or is it a full-time equivalent? Can I take 2 part-timers and they become a full-time equivalent? We expect guidance on that point at some point. I believe the SBA and the Department of Treasury are trying to handle all the application questions currently, and then they're going to get into the loan forgiveness. And I know it's obviously a critical factor to most folks as they're getting into this program, but I expect that guidance to come out in the next couple of weeks as these loans are being applied for. So if you have a reduction in your FTEs from the 8-week period over a measurement period, so the standard measurement period is looking back to February for the denominator of this calculation is looking at a period from February to June of 2019. So you would take your full-time equivalents for the 8 weeks over the full-time equivalents from the prior measurement period, and that would become your calculation. That's how you would determine your loan forgiveness amount. If you have a reduction in salary that's greater than 25% to any employees making less than $100,000, that will also eat into your loan forgiveness amount. One important note on that FTE calculation, there are provisions that allow, if you have a reduction in FTEs, if you bring those employees back by June 30th of this year of 2020, then the reduction based on that calculation we just went through does not apply. Again, I really expect that there's going to be more guidance on these points because there's there's some uncertainty in the way the acts are drafted currently. How do I obtain loan forgiveness? So after you go through this 8-week period, you're gonna apply. You have to apply to your lender, and then they're going to verify that your FTE account, the amounts you spent, et cetera, and then they're required to provide a decision on the loan forgiveness within 60 days. And then the last bullet here is that loan forgiveness. So in your standard debt forgiveness, that's typically treated as taxable income for federal income tax purposes. The CARES Act specifically provides that the forgiveness on the PPP loan will not be included in federal taxable income. And then quickly, just some miscellaneous provisions here. So the guarantee was waived, the collateral was waived, credit elsewhere was waived, only required to be in business and have payroll costs as of February 15th. And then this next piece, there is a requirement, and anyone that's done the application has seen it and had to either initial it or somehow go through your e-file process with your bank, that the loan is necessary to support, that there's, due to the uncertainty in the economic environment, the loan is necessary to support ongoing operations due to COVID-19, and that the funds will be used to retain payroll. Also, you can't have an existing SBA loan for the same purpose. That first bullet, I don't know where that's going to play out. I've read some articles on, we have a business. There's currently uncertainty. There's uncertainty for everybody. I don't think anybody can sit there and say there's no uncertainty. But if I have a decent year and my revenues go down by 10% or they go up by 10%, can they hold that statement against me? I don't know how the government's gonna react to that. There's absolutely no criteria in the CARES Act that would say, hey, if you had a revenue reduction by 20%, then that's going to impact your loan forgiveness. But I want to point it out just so that folks are aware of that statement and that good faith certification. And like I said, as guidance comes out, we'll certainly share whatever we can. Last bullet there. So a lot of folks are asking questions like, so there's payroll tax deferral, and then there's worker retention credits that were also added by the CARES Act. And the CARES Act specifically provides that if you are approved for a PPP loan, you can't claim worker retention credits. And further, if you have a PPP loan forgiven, that you're not eligible to defer your payroll taxes. Well, that becomes a timing concept, right? I mean, a lot of folks are right now, they need that cash. They want to defer those payroll taxes at a minimum. The employee retention credit has some criteria that you may not be eligible, that may not make you a candidate for that. But anybody is a candidate for payroll tax deferral. And folks are kind of looking at their situation and saying, can I defer taxes now? So we kind of looked at this. There's like 3 different scenarios that could play out here, right? You've kind of got your best case scenario with the deferral would be you defer taxes now, you go through the PPP process, and you have, you've got whatever 15 to 30 days before you get dispersed the funds. Then you've got to wait out an 8-week period, and then you've got to wait out potentially a 60-day period to find out whether your loan was forgiven. That to me would be the triggering date of loan forgiveness. And so if you deferred taxes up until now, you would not know about that loan forgiveness for potentially 5 months. Best case scenario is that you are not eligible, so you defer taxes now, that's valid. And then once you're approved for a loan, you're not eligible to defer taxes from that date until the end of December, which is the date that the payroll deferral ends. The middle case would be that you would defer taxes now, you get your loan forgiven, and then there's a catch-up payment with no interest and penalties. And then the worst case scenario would be the IRS somehow takes a position that you should have known you were going to get loan forgiveness, and then they hit you with penalties and interest once the loan's forgiven. I don't think that's going to be the situation. I think it's going to be either the middle case or the best case scenario there. So, okay, so that's the last bullet. There's any more? You could go to the next slide there, Frank. Okay, FAQs. These are the questions we were hearing about. The eligibility, how will foreign owners operations impact my application? That was on the old application. It was a specific question on the sample that came out the Wednesday before. That must have been April 1st. Maybe that was an April 1st joke. But that sample application said if you had a foreign owner who had more than 20% ownership, then you basically would not be approved. Payroll costs, like I said, that's been answered now. You can use either. Payroll costs, do I include withholding? We discussed that. That's been answered. Just keeping in mind, you've got 2 dates. You kind of got a flag in the ground on Monday, April 7th, and that's where the new guidance kind of comes in. You may be able, if you applied prior to April 7th and took a position on some of these tax matters or independent contractors, you may get approved. Like I said, I have a client that did get approved, and they only had independent contractors. Payroll cost measurement period. What if I wasn't in business? So we talked about that a little bit. If you weren't in business for that whole period, we think you can use the January and February timeframe for your measurement. Frank, you went through some of the new guidance. I expect there will probably be additional guidance that comes out. Banks, where do I reach out if my bank won't accept my application? That's been, and Frank or anyone else here, you can comment on that. That's been a source of controversy and I think a lot of uncertainty, where folks, generally what we were hearing is you had to have an existing lender relationship with the bank in order for them to even process your application. That got some bad press, and I think the SBA made some comment on that the banks weren't supposed to be kind of lender shopping. But my advice would be, if your bank is saying that they're not going to accept your loan because they're capped out, go to the SBA website, and I think we're going to put it on our slides that we send out. There's a list of eligible SBA lenders that's probably being updated daily, and find one that will take your application. I had a client that their existing lender was not going to take their application. They searched around, found, I think it was Bank of Danbury. Some of the smaller banks are approved and may not be getting the same volume. Sent the application in and was approved 2 days later.
Hey, Bill.
Yeah.
Question came on. Do you have to apply for the tax deferral or do you just not pay?
Yeah, you don't have to apply for the tax deferral. You do have to reach out to your payroll company. So if that's something that you guys are looking into, to reach out to ADP, Paycheck, whoever your payroll company is, and just set that up. That question came up internally, Frank, when we're talking about that not being eligible for the PPP loan and the deferral. While I don't think the worst case is going to be where the IRS goes with that, you may want to, if you applied for a loan, if you're going to be applying for a loan in the very near future, you may want to hold off. And what was the term we used, Frank? Use an abundance of caution. Wait till your application is approved, and then make that choice to defer payroll taxes by contacting your payroll company. I would hate for someone to for that to hold up an application. And like I said, I wish I could say that the banks had a template they were using to both accept applications and a due diligence template, but it does seem like they're kind of all over the map. And I would hate for that, an answer to that question if the bank asked to kick your application out. So take
Bill,
that.
I know we're running a little long, but there's another question that I think would be worth discussing verbally. What is the date What date is the FTE that needs to be employed during the 8-week period established? For example, if I had 15 FTEs on February 1st, 2020 and 7 FTEs at my origination date, do I have to bring back all 15 FTEs to qualify for loan forgiveness? I think the question is, when does that FTE measurement for loan forgiveness begin? And I believe it's under the same period that you applied your payroll cost to in your application. Isn't that right?
Yeah, the calculations, they're going to look at a quotient, at least as it's written in the CARES Act, and so the numerator is going to be your full-time equivalents during the 8-week period, right? So some sort of average calculation of your FTEs during that 8-week period, that becomes your numerator. So if you got a $100,000 loan, the loan forgiveness, as the guidance is written it up, is supposed to be calculated like this. Take your $100,000. What were your full-time equivalents, the average of your full-time equivalents during that period? If that's 15, if you had 1 employee prior to that, but you had 15 during the 8-week period, that's going to be your numerator. And then your denominator is going to be your full-time equivalents during that period from February to June of 2019, or there are other options if you were a startup or a seasonal business, but that's the way the calculation is going to work.
Okay.
So quickly, when can I expect the funds? We're hearing, I talked to a client yesterday. They were approved for a fairly substantial loan. Didn't hit the cap, but it was pretty significant. They were told by their bank that they can expect them between 5 and 30 days. And I know that's not what most folks want to hear, but that's what they heard. 30-day was what I had heard early on, that the intention was to get this money into the borrower's hands within 30 days. So I guess I would say by the end of April at some point, for those that applied early. Can I receive a loan for less than 2.5? This is a question I received. You're going to have to talk to your bank. The application is pretty straightforward. I guess you could fudge your monthly payroll numbers, although I don't think I would want to do that. I would put in for the max. There's no prepayment penalty. So worst case scenario is you apply for a loan of 100, you only want 75, so just prepay 25 back. What happens if I terminate furlough employees but bring them back? So we went through that. If you bring them back by June 30th, then that reduction for loss of FTEs, and I guess the mechanical way, if you lost an FTE but then brought back that FTE by June 30th, you would bring that back into your calculation. I didn't touch on this, the loan forgiveness. So it's not in the CARES Act, but this 25% rule came about pretty quickly in the guidance that came out after the CARES Act. They're only going to allow you, so when you look at your loan forgiveness, your $100,000 loan, they're only going to allow you to spend 25% of that on those other costs, right? Rent, utilities, interest on mortgage obligations. If you spend more than 25%, right? So you spend your $100,000 in the 8-week period, but you spent $40,000 on rent. They're not going to, even though it's an eligible use for the loan proceeds, they're not going to allow that additional amount to be included in your loan forgiveness amount. What if I make a mistake? Bill, go ahead.
Another question on that one is, do they define what should be included in utilities and rent? I don't believe they do.
Yeah, I haven't seen anything, and it's a good question. It's not one that we've heard too often, but I have heard it. And I'll answer on the utility question, because I have heard some guidance on that. The utilities, they're looking at your heat, your hot water, your electricity. They're not looking at your telephones or other things that aren't necessary utilities to operate a building. That's what I've heard as guidance. Again, I haven't seen anything official from the Treasury Department, the SBA. At one point, the U.S. Chamber of Commerce put out some information, and then the Senate Finance Committee put out some information. Those have been the 3 or 4 sources of official guidance, and then you've got obviously you got a lot of write-ups from folks like us and law firms and everyone else.
Yeah.
Okay.
Hey, Bill, I'm going to jump. I'm going to keep going. We're running a little long, but I think it's all based upon really good information. I'm going to say right now, I'm not going to go through these slides much at all. As everyone knows, one of the first or second responses was the Family First Coronis Response Act, which kind of mandated certain sick leave requirements for all employers, including those under 50, and also added some family medical leave requirements. The slides dictate pretty much the details that you need to be aware of and the tax credits. What we have been recommending to all of our clients and others that reach out to us is if you have questions in regards to how to apply this, how to apply the provisions, how to apply the maximum pay that needs to be given to these employees, and whether certain things qualify, please reach out to your employment attorney. A lot of these relate to employment law. They relate to HR related issues, and it's really important that you understand what your requirements are. One thing I will say is if you're planning on, or if you think this is going to do a lot of damage to your business and the ability to kind of, and will jeopardize kind of your viability of your business as a going concern, there is a way to apply for an exemption under these rules. You have to apply for the exemption. You cannot just assume that because you're under 50, it doesn't apply to you. So please, again, work with your attorneys and make sure that you're working on a response if you want to qualify for an exemption under the requirements due to the fact that you think it will do your business harm to the point where you'll not be able to continue as a going concern. There are certain credits. Bill, I don't know if you want to jump in here, but in the sake of time, we have also some of the tax rules to go over. So you want to jump in really quickly on the tax credits?
Yeah. So the if you're mandated to make this to have this paid sick leave and paid FMLA and like Frank mentioned, I mean there's a lot of detail here, and we don't have the time, but there's only 6 criteria that someone would require to meet in order to mandate this paid sick leave. It's not a situation where employee just doesn't want to come into work or is just nervous and doesn't want to come into work. So those criteria are listed in the slides. But if you are mandated, then the government's going to give you tax credits for every dollar that you spend on this mandated sick pay and family medical leave pay, and that will be applied against your the employer component of your employment taxes, right? So again, FICA, and to the extent that, and those credits can be applied to your gross, right? So it doesn't have to be a one-to-one correlation between employee that you're paying for sick leave and the taxes associated with that individual employee. To the extent you have more credits than taxes, then you can get a refund, and that is being the IRS published Form 7200, so that's on that form. And we're recommending folks that if you are going to be if you're making this mandated sick leave and family medical leave, to again talk to your payroll provider and adjust down your deposits, because that'll give you that money on a much quicker basis, and then when you reconcile, you can apply for the refund of the credits. So I'm going to go through this stuff really quickly. I apologize, we are running late, but tax considerations, for the most part, and we have all this on our website. We have a document called Tax Deadlines. We've gone through, at least from an income tax perspective, looked at the extension of the federal filing deadlines and the estimate payments, and then the states as well. The business tax consideration. So the CARES Act, like I said, had a lot of provisions in it. The employee retention credit, we touched upon briefly, but that only kicks in if there's a government ordered closure or partial closure of a facility, or a 50% reduction in your revenues in the current quarter compared to the comparable quarter. I guess they're looking at 2019. If you meet one of those situations, if you retain employees, you can get a tax credit of up to 50% of the first $10,000 you pay them, and those are also refundable tax credits. The deferral we discussed, you can defer your taxes. They're deferred until December 31st of 2021. 50% of the deferred tax would be due at that date, and then the balance, the remaining 50%, would be due December 31st of 2022. Net operating loss modifications. The CARES Act put in a 5-year carryback rule. So the Tax Cut and Jobs Act from 17 eliminated the carryback provision. This puts it back in. Also allows NOLs. The Tax Cut and Jobs Act had a 20%, or NOLs were limited to 80% of your taxable income. This expanded that to 100%. So you could have a situation where you had NOLs in 2018, you had income in 2013, and the Tax Cut and Jobs Act would not have allowed you to carry back any losses. Now you can go back five years and then that 13 return and get cash. All these provisions are aimed at getting cash to businesses. AMT, again, the Tax Cut and Jobs Act phased it got rid of the AMT tax, but then phased in any credits that you had over a certain period of time. The CARES Act basically allows those credits to be refundable for 2019 and 2018. Business interest expense increased the business interest expense limitation from 30 to 50% of AGI, and also allows companies to use the 2019 year as their measurement year, as their AGI is probably going to be significantly greater in 19 versus 20 for purposes of the 2020 return. The qualified improvement property, that was kind of known as a glitch of the Tax Cut and Jobs Act, where it treated that property as 39-year property and therefore not eligible for bonus depreciation. That was always intended to be fixed, but it wasn't, and now the CARES Act has fixed that, so that property becomes immediately depreciable, or you can write off 100% of it under the bonus depreciation rules. Charitable. Okay, so let's go to the next slide on the individual. We talked about the loan forgiveness, individual tax consideration. So the recovery rebates, that's what you probably heard on the news most often. It's the $1,200 for individuals and the $2,400 for married filing jointly. That's really an advance on a credit you're going to get on your 2020 return, just mechanically. So if and it's got thresholds. So once you hit $75,000 as an individual, it starts phasing out, and then $150,000 for married filing jointly. Retirement plans, it allows folks that are impacted by COVID-19, and that means diagnosed or having a spouse diagnosed or having adverse financial consequences related to the business. It allows you to withdraw up to $100,000 out of your retirement plan without the 10% penalty. And then once you take that out, you can recontribute those amounts without the current caps that are in place within 3 years. Charitable contributions individuals are allowed a $300 charitable contribution, even if they don't itemize. And the corp limit was increased from 10 to 25%. If you do itemize as an individual, the charitable contribution deduction is unlimited. That was previously capped. And then the student loan piece allows employees to not treat as taxable income $5,250 if their employer's paying their student loans off. So we quickly went through those tax. Like again, we have some material up on our website that goes through those tax provisions in a lot more detail.
Hey, Bill, couple questions. We are pretty much at the 1 hour mark. We still have a number of people listening in. Obviously, people can jump off whenever. Thank you very much. We have our contact information up. Please don't hesitate to reach out to us. We'll continue to answer a couple of questions here. And then we'll also get the Q&A out as well as the slides out to people as quickly as possible. Hey, Bill, one of the questions was relating to the question on, I lost it. I think it was a question on 1065. Maybe someone answered it already. I'm not sure if someone else had answered it, but there was a question on whether the 2020 1065 was actually also extended, the 2020 tax form for 1065.
So that's a good and a very timely question. It originally was not, although I do believe I saw some guidance, I think what I was reading through this morning, that it was allowing for folks that may have been so impacted that they didn't file their normal extension, that it was providing an extension for those 1065s. I think it had there was a definition on that piece, Frank, which I don't have all the information on, but just generally, I think the 1065 did have a kind of a late after the fact extension, but it might only be limited to certain circumstances.
Okay, and we just confirmed if you have loan forgiveness under the PPP, it is not deemed taxable. Just to reiterate, that question came up again.
Yep. Yeah. Just one comment on that is it's not taxable for federal income tax purposes. I don't know what all those provisions, all the provisions I just went through, I don't know how the states are going to handle that. That's kind of our next kind of task, is to try and understand, okay, well, where are the states going to go with this? I mean, they haven't really issued anything other than they're filing deadline extensions. But are they going to decouple from that? Are they going to, depending on whether they've got what their conformity with the Internal Revenue Code is? So while it's not subject to federal income tax, it may be subject to state income tax, depending on which states you have to file in.
Yeah, and Deb, I don't know if you want to jump in here. There's a question on if you do your own payroll, how do you go about deferring your taxes? Is there some advice that we can give people who are managing their own payroll? And is there a process that we're comfortable talking about, or will we be able to answer that in more of a written form later?
I would defer to Bill on that question, or we can respond in writing after.
Okay, perfect. Hey, Bill, so if you do your own taxes or you do your own payroll, is there a different process for deferring your tax, or you just do it basically on your own, right? You don't have to seek approval for that, right? You just defer the tax, you just don't pay it.
Yeah, I mean, I'm not a systems guy in terms of how that would work, whether it's through QuickBooks or some other software. But yeah, there's no like application you have to file or election you have to make.
All right. I don't know if anybody else sees any questions. I know there was a question relating to how the treatment of people that are getting paid reduced salaries if they're taking FMLA leave, and how that will relate to loan forgiveness calculations, because now you've got people getting paid less, right, Bill, versus in a period of measurement versus what they got paid when you applied for the loan on the average monthly payroll.
Yeah, and the HR, I'll call it the HR 6201 sick leave and medical leave, like that's not an includable cost in the PPP loan process. So I know some companies have their own sick leave and medical leave, and that's eligible, but the portion that you're mandated by under 6201 is not eligible. So you may want to play with those numbers a little bit to determine how kind of best suits your individual fact pattern.
Okay. Next question that came in, and again, some of these may be specific and we may need to get back to you, is any thoughts or information on self-employed forgiveness calcs? I don't know if there's a point I'm missing on that, Bill, but I think the measurement process would be similar, right? What your average monthly amounts that you earned during that payroll period that you applied for the PPP loan versus what your measurement period on a go-forward basis on the income side would be, right?
Yeah, it does present a really good question though, because sole proprietors, self-employed individuals, they may have employees, they may not. And so if this is in reference to a business that doesn't really have employees, how do you get into that calculation, which we talked about earlier, with the numerator and the denominator being full-time equivalent employees and full-time equivalent employees if you don't have them? My guess would be that the SBA will issue some additional guidance on how that sole practitioner or that independent contractor is going to be treated for purposes of that calculation.
Yeah, I would agree.
It's the only thing that makes sense,
They
right?
probably need additional information on that. I think we're just getting into the period, right, where sole practitioners and independent contractors can apply under the PPP. There was a delayed start date for them, if I'm not mistaken, for application purposes.
Yep.
And I believe there's probably going to be guidance coming out on that, but also we would expect, and I think you and I spoke about this, Bill, we would expect forgiveness guidance to be coming out later for clarity, because they're just focusing right now on trying to get people through the application process. And as we read the guidance, some of the forgiveness, that's, you know, the concepts that are outlined in the CARES Act are a little bit turned around, and I think we're going to get some clarification on that as well.
Yeah, I mean, you know, Frank, I've been kind of chirping from the top of the hill here on some of the language that in the CARES Act that I think needs to be amended or somehow either revised, amended, or new guidance needs to come out from the SBA, the Treasury Department, on how that calculation is going to work. Not only in just its core calculation, but certainly on some of these other items that need interpretation.
Yep. Okay, I think we're going to wrap it up. This has been great. Thank you, Bill, as always. You did the majority of the talking. Amber and Deb behind the scenes talking and answering questions through the Q&A process. And thanks everyone for attending. Please reach out if you have any questions, and continue to look at our website. We'll be posting updates routinely. And thanks again, and hope everyone stays safe and stays well. Thanks very much, everyone. Bye.
Thank you.